you for joining Jennifer Shouse and Associates in our 2019 Webinar Wednesday series. We are coming to you live from Washington, D.C. Our webinars are held every Wednesday, and you can find the upcoming schedule on our website. Past webinars and all recordings are also on our website and on our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speaker today, you can contact her directly with the contact information that's on the last slide. All right, this is just a little bit about us. We are a Washington, D.C. based firm and provide services for federal contractors. This ranges from market analysis reports to proposal writing and also post-award compliance. More information is on our website, so please visit us. We now offer advertising in our newsletter and webinars, so please email me if you have any questions or you want more information. All right, so we're going to go ahead and get started. Our speaker today is Jenny Clark from Solvability, and thank you for joining us, Jenny. Today we are going to be covering rate and pricing methodology.
Well, thank you. This is Jenny Clark with Solvability, and today's session is all about rate and pricing methodology as much as I can explain to you in 15 or 20 minutes. What we want to do is give you some structure in what you should expect when you are calculating per proposals or pricing, and that should actually tie back to your cost accounting records and your cost information in your financial statements. Next slide. When I'm talking about rate and pricing methodology, I'm really talking about it in context of small business. Large businesses have a lot more structure to this, and they won't do it as simply as the way I'm doing it. So let's just talk about these 4 components that you have to be taking a look at. Number 1 is going to be your profit and loss statement. Number 2 is going to be your direct cost versus your indirect cost. Number 3 are going to be the bid rates that you're using for a specific proposal versus the target rates is where you'll be at the end of the year. And number 4 is how often do you want to update this, which I usually say quarterly. So let me run back through those individually. Every month you've got a profit and loss statement. Many times the profit and loss statement for the month of January ends on January 31st. You're not going to have actuals till about February 10th or February 15th. Your information is not going to stay current if you wait every single month for the actuals. What you have to do is create, here's where we are every single month on an actual basis, but what you really do your work against is your projection or your budget. But you do want to have a profit and loss statement, and what I like to prepare is one that has month-by-month actuals, so you can see the trend across the whole year. And you always want to go, if you're a small business, through December 31st, unless you have some weird accounting period end. But most small businesses go January through December as their calendar year, their financial year. On your profit and loss statement, it needs to be structured in a very specific way. You have to do that in order to be able to pass a DCAA audit, but you also have to do it in order to price competitively and consistently compared to your peers in government contracting. Because if you're using some weird way to calculate it, your bottom line might be right, but the way it gets compared against somebody else's proposal, you're going to be way out of line. And you're going to really get tossed out because they're going to say, oh, these people don't know what they're talking about. So you want to be consistent and follow best practices that are used by everybody else. And if you have no information on that right now, I would go to DCAA.mil and look for the document called Information for Contractors, download it, and read through that carefully as the first place to start learning. Number 2 is your direct cost must be segregated from your indirect cost into fringe, overhead, and G&A and exclude unallowable costs. Oh gosh, this is accounting speak. Direct cost, that's the billable cost. If you're doing a project at White Sands Middle School Range and you've got 15 people out there, the 15 people working on that contract are called direct. Indirect costs, those are support costs that can't be identified to a specific contract. Like payroll taxes, I pay that on an annual basis. It doesn't matter what contract it's on. It's kind of it's in what's called a pool. So my fringe, my overhead, and my G&A are all considered indirect or support costs. And those actually get spread, allocated, whatever way you want to consider it, over all of my other types of costs. The last thing I did want to include is the word unallowable costs. These are not costs that you can't deduct off your tax returns, but they're considered expressly unallowable costs that you are not supposed to use in your pricing when you do a price, and it really comes out of your profit. The common ones are interest expense, lobbying, penalties, fines, entertainment, those type of costs. And there's actually a definition. If you went and typed in on the internet, unallowable costs, government contracts, you should come to that list. Your bid rates are your target rates, where you think you're going to be at the end of the year. Here we are in January. Right now, your indirect rates are not reflective of what they'll be by the time you get to the end of December, because actually we've had 2 holidays and some weather days. And right now, if you based your entire year on what happened in January and just multiplied it out, that would be a bad pricing method. The last thing is, how often should you update your budget that you're using to create these? I recommend that you only do it once a quarter. If you start doing it every month, you're really just like giving yourself brownie points because you hit your target perfect every single month, and you don't want to forgive yourself that much. You also don't want to go through the exercise of it. The quarterly should be, you should review your actuals quarterly and say, oh, now that we know we don't have that group, we don't have that contract anymore, we're going to update going forward because that was something we didn't know at the beginning of the year, so it's okay to adjust it. But only do that once a quarter. And I usually recommend that people base that on 3 different reports. One's called your labor utilization, which is who's working on which contracts. The second one is your active contract listings, which contracts are in, which ones are about to end, which ones are about to start. And the last one is something I just call a trend income statement. And I just want to see where we're going on that overall. Next slide, please. Again, a lot of words here. When we're talking about your monthly income statement, should be a standard format to meet your FAR requirements. I've told you where to get the information that you need to. If you can't produce an income statement that meets these standards, in my opinion, you could also never pass a DCAA audit. So there's a reason to do this. The other thing I wanted to throw in here is people will tell me, I'm all fixed price, I don't need to pass a DCAA audit. That's true. But if you aren't doing your accounting consistently, that may be causing you to lose bids because your math is not right. It's not in a standard format. The other thing is people will say, well, I've never been audited by DCAA and I never will be. And that could be true. If you're not a prime contractor, they may not come back and do an audit. If you get a cost plus contract, even if you're a subcontractor, you're subject to audit, although they normally won't do an audit. But you just really want to make sure that you could prove that you could pass a DCAA audit if that ever came up. Because if that opportunity came across and you found, because you never invested in your accounting system, that you just lost the opportunity for a $5 million contract, I'd be really disappointed. So if you're not processing following the standard method that would be DCAA compliant, then again, you're pricing apples and oranges. It's not comparable, which means your stuff is kind of trash. Let's go to the next slide, please. This is, in my opinion, what your profit and loss statement should look like. This one happens to be highly summarized because you would have actually detailed elements under each of these categories. But my standard profit and loss statement that I see for a government contractor should have this structure. If they don't, something is wrong. And many times they'll say, well, my CPA set that up that way. Your CPA cares about taxes. They don't care a bit whether you win a federal contract. So they're not going to know to do this. And even if your CPA was interested in helping you and do this, they are not government contracting specialists. And you really do need to work with somebody that understands that. So, if you're just going to a pediatrician and you have one format, but if you're going to go to a cardiologist, you're going to get something different because you've got to prioritize different things. These are segmented into some standard sections. Up at the top under your direct costs, that again is your billable people, your direct labor. You'd have direct travel for the travel expense reports that are charged to the jobs. You could have direct subcontracts, direct consultants, other elements of direct cost that would go up in the top section. Then you would also have your indirect cost, And I've called those in the past fringe, overhead, and G&A, or FOG. Fringe is your payroll taxes, your leave, and your group benefits. Overhead is the support cost of your technical workforce. If you're in if they're in your building, there's going to be some facility cost, but you could also have overhead costs. The cost of bringing that person and keeping them on your team might be training, certification. Maybe you have to do facility security clearance activities, different things like that, background checks. Recruiting costs are a big part of it these days. That needs to be in your overhead. If it's not, you're not recovering all your costs. G&A is your general administrative or corporate expense, and that is also both of those are broken down into labor and non-labor. The reason they're broken down into labor and non-labor is everybody on the payroll has fringe benefits, and so there's an allocation that we have to run of the fringe benefit relationship to the labor. But this is kind of a standard, super summarized income statement or profit and loss statement. Next slide. Mathematically, these are quick numbers. There's more than one way to calculate fringe, overhead, and G&A, so don't take this as gospel. Your fringe rate is typically your fringe benefit cost, payroll taxes, leave, and group benefits, divided by productive labor. Productive labor would exclude paid time off and holiday because those costs are in the fringe pool already. So productive labor would be direct labor plus overhead labor plus G&A labor. In my example, I've got $36,000 worth of fringe benefit cost. My productive labor is $100,000 of direct labor, $10,000 of overhead labor, $10,000 worth of G&A labor. My fringe rate, a perfect 30%. Next slide. Overhead rate. Again, you can see I've got an asterisk, and down at the bottom left, I'd say there's more than one way to calculate an overhead rate. In general, there's cost associated with the fringe benefit of direct labor. Some people put that in the overhead pool. Other people put it in the overhead base. I tend to call it left coast and right coast just to let people recognize there's a difference. In this case, what I'm saying is my overhead rate is my overhead labor plus the fringe benefit related to the overhead labor. And what I always like to remind people is wherever the labor cost goes, the fringe follows. And then I have my fringe on direct labor plus my overhead non-labor. So that would be, let's say that I've got an FSO that does my security clearances. Their costs might be charged to overhead labor, so the fringe related to that person. The overhead non-labor might be some recruiting expense that I'm paying for subscription to a recruiting portal. My overhead pool, in this case, I'm adding up $10,000 of overhead labor plus the fringe on overhead and direct labor plus my overhead non-labor. I come up to $48,000. That's divided by my direct labor of $100,000. That's 48%. Remember again, though, I did round numbers, and I did some of this to make the math easy. So 48% is meaningless one way or the other for overhead rate. Your overhead rate is going to depend on your company. It's just like asking, how much cayenne pepper did you put in this barbecue sauce? So I've got a 48% overhead rate, and in this mathematical calculation, the fringe on direct labor is included in that 48%. So it's almost like 30% of its fringe and 18% of its other overhead. Next slide. The last component is G&A, general and administrative, or corporate expense. The formula is my G&A pool, which is made up of G&A labor plus the fringe on G&A labor. Remember I said the fringe follows the employee, plus the G&A non-labor. G&A non-labor could be accounting fees, bank fees, legal fees, taxes and licenses, all those type of different costs that are part of the corporation, whether you have a contract or not. That's how you decide whether it goes to overhead or G&A. But the G&A cost tends to be the back office staff, the headquarter cost. So my mathematical formula is my G&A labor plus the fringe on G&A labor plus my G&A non-labor. That comes up with a G&A pool of $18,000. That's divided by the G&A base, which is pretty much all other costs in your company. It's going to be any direct cost plus the overhead pool, and that amount is coming in this example to 11.39%. I think I mentioned that 8 to 15%, 10 to 15%, probably the going rate for G&A. When you're a small company, your G&A rate could be a lot higher. It starts to come down when you start to get a balance between the number of billable people in the company versus the number of admin people in the company. And what I tell people in general, if you have a company with 10 people, 8 of those people should be billable at a minimum. And the more you add to your billable workforce without increasing those 2 headcount people in admin, the more cost effective you'll become. But until you're at that point, it's a squirrely number. Next slide, please. Oh, we're already here. So this is Jenny Clark. My email address is jwclark@solveability.com. That's SOLV as in Victor and the word ability.com. And you can always text me at 256-882-6276 if you'd like to set up a call. I'd say that's it. Back to you.
Thank you, Jenny. Thank you for sharing your knowledge and insight today. Today's presentation has been recorded and can be found on our website or YouTube channel within about 48 hours. If you have any questions about today's topic, please contact Jenny at the phone number or email shown on your screen. Thank you, everyone. This concludes the webinar.